Hello guys, welcome back to another exciting video. So today I will be teaching about bank reconciliation. What is bank reconciliation statement? Why there is a need for a bank reconciliation statement. What is reconciliation? Is the action of making one view or belief compatible with another. Okay, so let's say I have a belief, my friend has a belief, we come together for us to get along, we reconcile our beliefs to see what do we have in common and what we do not have in common, in order that what she has I should have as well and know, or what she knows I should know as well, and what I know she should know as well. Let's take, for example, maybe two Christians or whatever. They come together to talk about the word, and what I know I teach my friend, and what my friend knows my friend teaches me. And after that session, we would have reconciled any differences or any information that I didn't know or my friend did not know before we met. So that is reconciliation. So we are going to take our bank statement and compare it with our cash receipts journal and cash payment journal. So in our cash receipts journal, that's where we record every money that we received as a business. So anything that was received by us as a business falls under the cash receipts journal, and whatever that we have paid as a business falls under the cash payment journal. So we have to check that as a business we do electronic transfers, or if somebody has paid that in cash, we go to the bank and deposit the money. So all the money that we had deposited into the bank and that we had received or paid out using FET services must appear on our bank statement. So whatever we have done during the month, when we go to the bank and print out the bank statement of our business account, it should reflect what was received and what was paid in the books of the business, mainly the cash receipts journal and the cash payment journal. So we are just comparing. Whatever that appeared in our own books and did not appear in the bank account or bank statement, we have to write them down in the bank reconciliation statement. So those are items that we paid so and so, we received money from certain clients, but they do not appear in the bank statement, but we have that record in the books. Maybe, for instance, the client had paid in cash, we had deposited the money into the business bank account, but has not yet reflected for different reasons, maybe technical issues, or somebody has sent us a proof of payment, and after we had received the proof of payment from that particular person or customer, we write it down in our books as we had received money, but the money that the person has paid was not an immediate payment. When somebody makes an immediate payment, the money reflects in your account immediately. So the account might take 7 or maybe 14 days or 3 days to clear and appear into our account. So all of those things that we know very well that we had recorded but have not appeared in the bank statement will be written in the bank reconciliation statement. But whatever that appeared in the bank reconciliation statement but did not appear in our journals, the cash receipts and cash payment journal, should be written in the journals. So we take our bank statement and, okay, this was paid, this was what, we record them in the correct journal. Sometimes even fraud could take place. One of the employees could have taken the money for themselves. It appears on the bank statement, but to us, they did not write it. So when investigations are conducted, that's where you will find out that, oh, so and so had taken money for their personal use. Or maybe sometimes the owner of the business has bought things for their own personal using the bank, the card of the business. So that will fall under drawings. But yes, and we still have to write it under CPJ. So let's talk about this statement. that a whole lot of students find hard to do. All right, so the first balance in the bank statement, which is balance as per bank statement, this one is the closing bank balance. It can be favorable and unfavorable bank balance. Okay, so when we debit the bank statement, the balance as per bank statement, it means that we have an unfavorable bank balance. What does an unfavorable bank balance mean? It means that the bank account has a negative or overdrawn balance. Okay, so the account holder of the business, meaning the business owns the bank. Okay, maybe we have not paid our monthly management fees, which is bank charges, and we do not have money in our account, so it has a negative balance. Or we have an overdrawn account where we have exhausted our balance and we are now using credit facilities given to us by the bank by the form of an overdraft. So that's how we get a debit bank balance. So just look at it. When you're given a bank statement, what is the value of the closing balance? Is it an unfavorable, which is a negative, or is it a favorable? Now, if a bank balance is favorable, we put it in here. This is unfavorable. This is favorable. I don't know if that appears. Bank balance. So a favorable bank balance, you have more money in your account. So with meaning deposits that have went into your account exceeds withdrawals. Withdrawals is when you go to the bank and draw money. Deposits is when you deposit money into your account, which increase your bank account. Okay, so that is how we do the bank balance. Now, if you are not given a bank balance at the end of the month, what you do is that this is going to be your balancing figure. You're going to be able to calculate this amount at the end. Bank balance as per bank account. So I will show you how you calculate your balance as per bank account if you are not given your statement, your balance. If you don't know your closing bank balance, you can do this as just a balancing figure, because this is usually the balancing figure if you're given everything. But if you're not given this one, it's a question mark in the question, this is the balancing figure. Now let's go to credit outstanding deposits. Okay, when we talk about outstanding deposits, we're talking about items that appear on the CRJ but not on the bank statement. As I have told you, anything that appears in our books as a business but does not appear in the bank statement has to be recorded in the bank reconciliation statement. So outstanding deposits are all the receipts, cash receipts, which do not appear because of reasons I have mentioned before. So that will always be credited because is an income. Remember, incomes are always credited and expenses are debited. Okay, it's an accounting rule. Income and expenses are equity accounts. So equity accounts increase on the credit side and decrease on the debit side. So which is why we have expenses being debited and incomes being credited, because they are equity accounts. Okay, us having money deposited into our bank account will affect two things in our balance sheet: our equity account and our assets. Okay, so our owner's equity will increase if we receive cash, and our assets will also increase as the bank balance increase, because bank is a asset. So asset increase on the debit side and decreases on the credit side. So hence why we credit outstanding deposits. So let's go to outstanding EFTs or checks. We do no longer use checks. Checks are no longer being used, but in old question papers you would still find examples which have checks. But now we talk about EFTs. Okay, electronic transfers. So because outstanding EFTs are things that we had paid for but had not yet appeared on the bank statement due to a amount having to be cleared after certain days, we debit them. We're going to list them. You might have a certain number of outstanding deposits, you list them. And then you might have a certain number of outstanding EFTs, you also list them. You don't just make a total and write them as one. It's very important. So outstanding EFTs are payments, and all payments, as they are expenses, they are debited. That's what you have to know. If you are given last year's big bank reconciliation and you see outstanding deposits and outstanding payments, outstanding EFTs, they will tell you in your adjustments if those outstanding deposits and outstanding EFTs have been cleared, meaning they now appeared in the bank statement. Let's say we are doing a bank reconciliation. Last year's reconciliation was for February. Okay, so in February we had outstanding deposits and outstanding EFTs. When we are doing bank reconciliation for March, if those outstanding deposits and outstanding EFTs are still outstanding, even in the current month, we still write them down in the new bank reconciliation of March as outstanding deposits and outstanding EFTs. So I hope we are clear on that one. So correction of errors made by the bank. Let's say the bank was supposed to debit an amount, but the bank has credited it by mistake. We do not correct that in CRJ or CPJ, okay, or bank. We correct that on the bank reconciliation statement. So whatever that was credited wrongly, we will just come and debit it. Maybe an expense in the bank statement appeared as an income. What do? Expense appeared as an income, so which means it was credited in the bank statement, but what do? We debit it, because they always say it will be, the bank said the bank will correct it in the next month's bank statement. So we do it here ourselves in the bank reconciliation statement, so that one view or belief compatible with another. So two beliefs are made compatible with one another. Okay, so what the bank has and what we have should be compatible. The bank is going to correct their mistake, but we also have to correct the bank's mistakes. You get it? So here, whatever, if the mistake was credited, then we debit the mistake when we're correcting it. But if the mistake was debited, we correct it by crediting it. Now let's talk about credit or debit balance as per bank account. Here, as I have told you earlier, if you are not given the closing bank balance, what you do is that you take the opening bank balance, you add the total cash receipts journal, and then you minus total cash payment journal. You will be given an opening bank balance if you are not given the closing one that comes here. Okay, so you'll be given the opening if you're not given the closing. So what you do is, when you're not given the closing, you take the opening bank balance plus the total CRJ that you had done, and then you minus the total receipts. Okay, so here, if receipts exceed CPJ, we write the amount in here. Just know that the total receipts we have, when we do this, when we have a positive answer, that positive answer we're going to credit it. But if we have a negative answer, we write it here. So Another thing you have to know is that if you maybe don't have this one and you try to balance this to check if you had done your thing correctly by first taking the opening bank balance, adding your CPJ, it's not going to give you a correct answer, because this activity or whichever activity that you have been given, it has been given in a way that it will make sense by just the way you do it. Okay, so this, you only do this calculation if you don't have this one. Remember that. Okay, but if you are given this baby here, meaning this one here will be the balancing figure, you will see between the debit and the credit side which one is bigger. If the credit side is bigger, then you will write the total here. Then this total will minus everything that is in the debit side, and then will be this figure. Or let's say the debit side is the one that is bigger, you calculate everything, then you do the total, and then this total will minus everything in the credit side, then you will have your positive answer there. Okay, so remember guys. Thank you very much for watching. In our next video, we will do an income statement.